The next pattern is the bullish on-neck line, which is also composed by two candles. The first is a medium-sized bullish candle. The second is a small bearish candle that opens with a considerable gap up. The logical interpretation here is that the fact that the second candle opened with a gap up and was unable to close this gap implies that there is a lot of buying pressure in the market and sellers are not strong enough to fill the gap, which implies that price will continue to go up. The bullish on-neck line appears when price is going up in order to signal a continuation to the upside. Next we have the bearish on-neck line, which is the mirror image of the bullish on-neck line. So it's a bearish continuation pattern composed by two candles in the formation. The first candle is a medium-sized bearish candle, and the second is a small bullish candle that opens with a considerable gap down. The fact that the second candle opened with a gap down and was unable to fill that gap implies a strong selling pressure in the market, and therefore price tends to continue going down. The bearish on-neck line appears when the price is going down in order to signal a continuation to the downside. This covers the complex continuation patterns formed by two candles. Next, we are going to study the complex continuation patterns formed by three candlesticks. The first complex continuation pattern formed by three candlesticks is called upside Tasuki gap, which is a bullish continuation pattern similar to the bullish on-neck line, but with a few extra details. The first candlestick in the pattern is a medium-sized bullish candle. The second candle in the pattern is a small bullish candle that opens with a gap up, and the third candle is a small bearish candle that fails to close the gap created between the first and second candlesticks in the pattern. It's clear that there is a lot of buying pressure between the first and second candlesticks. The third candle in the pattern adds more confirmation to the buying pressure because it fails to close the gap created by the first two candles in the pattern. In fact, it doesn't even attempt to close the gap. The bullish Tasuki gap appears when price is going up in order to signal a continuation to the upside. Next we have the downside Tasuki gap, which is the mirror image of the upside Tasuki gap. So it's a complex bearish continuation pattern. The first candle is a medium-sized bearish candle. The second is a small bearish candle that opens with a gap down. And the third is a small bullish candle that fails to even attempt closing the gap created between the first and second candlesticks in the pattern. It's clear that such a pattern implies a lot of selling pressure because of this failure to close the gap down. The downside Tasuki gap appears when the price is going down in order to signal a continuation to the downside. Next, we are going to see the complex continuation patterns formed by four candlesticks in the pattern. The first one is called bullish three-line strike, which is formed by three consecutive small to medium-sized bullish candlesticks, followed by one large bearish candlestick that closes more or less where the first candle in the pattern opened. The logic behind this pattern relates to the idea of quick exhaustion of selling pressure. Notice that price rises slowly and then all the selling pressure that was also building up is exhausted all at once. This opens headroom for buying pressure to continue. This can seem a little counterintuitive at first because of the size of the bearish candle and the fact that this is a bullish continuation, but the key is to understand this concept of quick exhaustion of selling pressure in this particular case. The bullish three-line strike happens when price is going up in order to signal a continuation to the upside. Next we have the bearish three-line strike, which is the mirror image of the bullish three-line strike. So it's a bearish continuation pattern. The pattern is formed by three small to medium-sized bearish candles, followed by a large bullish candle that closes more or less where the first candlestick in the pattern opened. The idea is the same as in the bullish three-line strike, but this time we are dealing with the quick exhaustion of buying pressure that builds up in the background as price slowly falls. When the buying pressure finally exhausts itself in the large bullish candle, sellers have the freedom to continue on their way down. The bearish three-line strike appears when price is going down in order to signal a continuation to the downside. Next, we have the final 4 candlestick patterns that are formed by 5 candles. The first pattern is called Rising 3 Methods, which is a bullish continuation pattern formed by 1 medium-sized bullish candle, followed by 3 small bearish candles, given that the third bearish candle closes where the first bullish candle opened. The last candlestick in the pattern is formed by a medium-sized bullish candle like the first candlestick in the pattern. The name of the pattern is a little confusing because the term rising refers to the direction that the pattern implies, not the candles themselves. And the third methods refers to the 3 candles in the middle. It's a bit confusing because the name says Rising 3 Methods, while the 3 bearish candles fall. The logic of this pattern is that the 3 bearish candles in the middle represent a temporary break in the buying pressure exhaustion, meaning that sellers assume control until price reaches the last level where buyers displayed high intent, which is the open of the first candlestick in the pattern. The 5th candle in the pattern resumes the original intent of buyers. The Rising 3 methods appear when price is going up in order to signal a continuation to the upside. We also have the Falling 3 methods, which is the mirror image of the Rising 3 methods pattern. So it's a complex bearish continuation pattern formed by 2 medium-sized bearish candlesticks in the extremes and 3 small bullish candles in the middle. The interpretation is the same as in the Rising 3 methods, but this time the sellers temporarily hold the exhaustion of their intent and let the buyers create 3 small candles up until the level where sellers began showing their intent in the first place. The pattern is complete when sellers resume the exhaustion of their energy with a medium-sized bearish candle. The Falling 3 methods appear when price is going down in order to signal a continuation to the downside. The next pattern is called Bullish Mat Hold, and it's similar to the Rising 3 methods, but this time there is a higher degree of buying pressure that doesn't allow the 3 bearish candlesticks in the middle to go back to the original place of intent of buyers. In other words, buyers begin to pick the market at a higher level than in the Rising 3 methods pattern, and that implies more buying pressure. The Bullish Mat Hold appears when price is going up in order to signal a continuation to the upside. The final continuation pattern is the Bearish Mat Hold, which is the mirror image of the Bullish Mat Hold. The interpretation follows the same rationale, but in the opposite direction. In other words, sellers stop the exhaustion of their selling pressure to let buyers breathe a little bit, but not enough to rise the market up until the original place of intent of sellers. This implies a strong selling pressure. Notice that in the Falling 3 methods, sellers let buyers rise more than in the Bearish Mat Hold. The Bearish Mat Hold appears when price is going down in order to signal a continuation to the downside. This finishes the presentation of the candlestick patterns that I find to be more relevant. If you do some research, you will find more patterns, but in my opinion, these are the ones that are more reliable, roughly speaking. Let's